Intraday trading doesn't work. Many people say this, right? I want to ask one simple question to you, friends. Do you know how to drive a Formula One car? I hope the answer is no, right? If you don't know how to drive a Formula One car, what you should say? Formula One car doesn't work, or I don't know how to drive a Formula One car. Using the same logic with respect to intraday trading, if you're not making money in intraday trading, what you should say? Intraday trading doesn't work, or I don't know how to take profitable intraday trades. If you're little sensible, you should say I don't know how to take profitable intraday trades, right? See, friends, intraday trading is just a type of trading in which you take the trade and close the trade on the same day. Market doesn't care whether you are an intraday trader, swing trader, positional trader. If you are right, it gives you money, but if you are wrong, it takes back your money, right? But at the same time, you should remember one thing. Whenever you get into lower time frame trading, automatically you get more number of trades. At the same time, you get more number of noise as well. You should ensure your system has an edge, and you should not take more number of trades, because if you take more than 3 or 4 trades, automatically you end up paying more brokerage, more taxes, right? So if you don't take more number of trades, and if you maintain your emotional balance, it's possible to make profits even in intraday trading. In this video, I'll be explaining two simple yet powerful intraday trading strategies. So please watch till the end. So without wasting much time, let's start. Before I explain the two important intraday trading system, you should know two important things. Number one is, what is the best time frame for intraday trading? Many people get confused with this. Some people opt for 5 minutes, some people opt for 15 minutes, some people opt for 30 minutes, some people opt for 5 minutes. So you might have this confusion in your mind. What is the best time frame for intraday trading? Let's say if you ask for if you go for 5-minute time frame, so what happens is you end up taking more number of trades. Let's say this is a 5-minute chart. You might take an open action trade here. You might take a trade here as well. But you might take some more trades here. You might take some more trades here. Okay. So whenever you use a 5-minute time frame for intraday trading, you end up taking more number of trades, like 4 or 5 trades minimum. So these 4 or 5 trades is not at all good. Even if you look at here, probably you might take an open action trade here. Might be a trade here. There might be trade here. There might be a trade here. There might be trade here. So minimum you take 4 or 5 trades. So that is why 5-minute time frame is not ideal for intraday trading unless you have a scalping mindset. And anything below 5 minutes is also not a good thing. Even if you go for 3 minutes, it is not good because you end up taking more number of trades, right? See here, you take an open action trade here, you might take a trade here, you might take a trade here, you might take a trade, one or two more trades here, trade here, trade here, trade here. So only scalpers can get into 3-minute time frame or even 5-minute time frame. But if you are in intraday trading, uh, 5-minute time frame and 3-minute time frame is not a good idea. At the same time, I have seen people who use 30-minute time frame for intraday trading. So if you opt for 30-minute time frame in intraday trading, you may not get a good entry and exit point on most days. For example, this is a 30-minute time frame in Nifty. Okay, so if you take a trade here, you get only one trade opportunity, and you might not have got a good exit point. Okay, you got only one trade. So this is the case. For example, here, if you wait for something, you would have lost an trade opportunity. Here you got only one trade opportunity if you are very clear. Okay, so even 30 minutes is a higher time frame because we need to close the trade at the end of the trade. We are not supposed to carry the trade because we are not swing traders or we are not intraday trader. I mean positional traders. So we should close our trade within the same day if it is intraday trading. So in that case, even 30-minute time frame is not a very good idea for intraday trading. So for intraday trading, 50-minute time frame is the best actually. Okay, so whenever you opt for a 50-minute time frame, you end up taking one or two very good trades. For example, if you have taken open action trade, it is fine. How and why, don't worry, I'm just explaining the importance of the time frame. Okay, so you might take a trade here or you might take a trade here. You don't, if you're using a 50-minute time frame, you don't get an opportunity to take more than two or three trades on any trading day. Here you might have taken one trade here, that's it, or maybe 1 year, that's it, right? So similarly, whenever you check uh, on any trading day, you will get only one or two, maybe one here, maybe 1 year. So in 50-minute time frame, so that is why I suggest to use a 50-minute time frame if you are using intraday trading. So this is one important thing. And the second important thing is whether to apply these strategies for futures or equity or options buying or option selling. So that is the maximum number of comments I get on my YouTube videos. So whatever the strategy I'm going to explain now, it is applicable for this equity chart. This is for example Nifty. That particular chart, it is applicable. So if you are using in equity, for example, Infosys equity or TCS, equity, Titan equity, so you can use that particular strategy as it is. Okay, that is one thing. And now, if you are trading into futures, definitely you end up taking margin, right? For example, if you trade in futures, for example, you trade in Infosys futures. So even if you have 1,40,000 rupees, you can buy one lot, which means 400 shares of Infosys. So I will go to Infosys here. Okay, so let's say your trade is somewhere here, 1944, and your stop loss is somewhere here, 1933, means 11 points. So you are taking 11-point risk in one trade. In equity, if you take the trade, there will not be much risk. But if you take trade in futures, for example, you are let's say you have 1,40,000, you take a trade, which means you are buying 400 shares with 11-point technical risk here, 11-point technical risk here, which means you end up taking more than 4,000 rupees, 4,000 into 11, 4,400 rupees approximate risk, right? Which means if you have 1,40,000, so it is close to, how much? It is close to, I'll open the calculator. Suppose if you take 4,400 risk divided by, which means this is your capital. So which means you are taking 3% risk actually. Okay. So I suggest if you are taking trade in futures, your risk should not exceed 2% per trade. Which means if you have a capital of 1 lakh rupees, you should not lose more than 2,000 rupees per trade if you're trading in futures, or whether you're trading in options buying or option selling. So for any trade, the general thumb rule is you should not lose more than 2% of your capital per trade. Okay, this is one thing. And especially the strategies I'm going to explain, I suggest to avoid these strategies in weekly options buying. Okay, so you can try the same with monthly options buying or weekly option selling. But with weekly options buying, if possible, try to avoid these two strategies, because in weekly options buying, time decay is very, very strong, and these two are intraday trading strategies which gives good results if the holding period is close to maybe 1 hour 2 hour minimum. So if you use weekly options buying, the 1 hour 2 hour holding, the time decay itself will reduce the premium. So because of this reason, I suggest to avoid taking trade with weekly options buying using these two strategies. Okay, so now coming back to the main strategy number one. So the strategy number one is open range breakout. Okay. So what is open range breakout? It is very simple. Many people think it will not work or it is outdated, something like that. But don't worry, friends. I will tell you how to use this concept in a very, very effective manner, and I will also show some of the whatever the stocks it may be. I will show the outcome of this strategy in some of the stocks or many stocks. Okay, so the basic definition of open range breakout is there will be a range. It may be 30-minute range or 50-minute range or 1 hour range. Ideally, I suggest to use 1 hour range, which means you will not take any open action trade. You wait until 1 hour. Okay. So once the range is formed, for example, after the 1 hour range is formed, if the price breaks on the upside, ORB suggests to take a long trade. Suppose if the price breaks on the downside, ORB suggests to take a short trade. Okay, so this is the ORB concept. This is the basic definition of ORB intraday trading system. This is one of the very old trading system actually. Now the problem is price is showing like this. For example, it goes little bit upside, it comes back to the range. It comes down below the 1 hour range, then it goes upside. It happens like this, and it is not giving very good results in the last few years. And because of this reason, many traders are not using this particular strategy. Okay, you can see some of the example. This is Axis Bank example. So this is IB range, which is nothing but 1 hour range. IB range stands for initial balance range in market profile terminology. So now if you look at this particular candle, price went upside the range, right? Upside the range, and again it come back. And if you would have taken a long trade in this particular candle, it would have taken your stop loss. But if you notice very, very carefully, the price moved in the expected direction only, right? So this is one simple example. Similarly, if you look at one more Axis Bank chart on 30th April, price went upside, right? If you would have taken a long trade, it would have taken your stop loss in this particular candles, but again after that it went upside, right? This is one more example, the same Axis Bank. Again, this is IB range. See here, the price went upside above the IB range. That is 1 hour range. Again, the price went on the downside. For example, if you have taken a long trade, it would have, your trade is in, but it would have taken your stop loss and then it came back downside, right? This is one more example. See here, if you would have taken a short trade here, uh, definitely it would have taken your stop loss, right? Similarly here, if you would have taken a long trade here, it would have taken a stop loss for your trade, right? So then how to avoid these kind of issues? So once whenever trader faces these kind of experiences, what they do is they dump the strategy and they look for some other strategy which is showing good results, or a friend is making good profits using that strategy. What people does is they immediately jump for that strategy without fine tuning this particular strategy. Okay, now what if you're really sensible and intelligent, what you have to do is you should not dump the strategy, but you should develop a filter or mechanism to avoid these kind of whipsaws or the failed trade entries, right? If you're really sensible, you should develop a filter to avoid these kind of scenario. Do you agree with me? Now, I suggest to use two filter. Friends, I have written a book on breakout trading, especially how to differentiate a breakout from false breakout. It is called as How to Make Money with Breakout Trading. This is one of the popular trading books in India. I've given the description, link in the description. You can have a look. So I'm using the same strategy from the book, and I'm applying it in intraday trading. So the first filter in ORB is the close, the breakout candle close should happen above the high of the ORB range, and the wick, wick should be less than the 20%. I'm going to explain the wick scenario with detailed example in the next few slides. So don't worry. So the first filter is the breakout candle close should happen above the high of the ORB, and the selling wick on the top side should be less than the 20% of the wick. This is one filter. And second filter in ORB is if you are planning to take a trade, for example, long trade, it should come above the high of the breakout candle, and a short trade, it should come below the low of the breakdown candle. Okay, so I will take in detail. For example, if you observe here, so this is 1 hour range, right? This is 1 hour range. If you look at the breakout candle, it closed above the ORB, right? Okay, so this is one thing. And second thing is selling wick. If you observe the small wick on the top side, it is less than the 20% of the entire body, right? So this is first filter. Okay, so many people ask me what is this 20% filter criteria. For example, if this is the breakout candle, if the low of the breakout candle is 90, if the high of the breakout candle is 100, then the close should be above 98 or above, because this only indicates the 2%, I mean the 20% of the wick compared to the entire body, right? So this is very simple. My suggestion is don't go with the calculation, friends. You just go with the naked eye. Just observe the breakout candle, a breakout candle. Just observe that. If it is very small, you can plan to take a trade. If it is a big wick, you can always avoid the trade. But remember, this is a specific rule actually. Okay. So now this is filter one actually. The filter rule is whenever the price uh, breaks above the high of that breakout candle, you can take a trade. That is your entry point. And the low of the breakout candle, if, for example, if you're taking a short trade, the high of the breakdown candle is your stop loss. Okay. So this is filter two. I hope it is very clear. There are two filters, friends. So number one is the breakout candle should close above the high of the breakout, the ORB range, and the selling wick should be less than 20%. This is filter one. And filter two is the price should break the high of the breakout candle. Okay. So in this case, this is filter two. Now, this is one simple example. Don't worry, I will also walk through with some of the recent examples as well, so that you will understand it in a better way. Now, if you look at this, the price didn't close above the high of the ORB range, right? And also it contains a selling wick. See, in the first case, you don't take the trade, right? Because it didn't close above the high of the ORB range. Also, it contains a selling wick. But in the second case, it closed above the high of the ORB range and selling wick is zero. There is no selling wick. So in the second case, you take the trade, right? In the first case, you don't take the trade. If you apply the filter as it is, you avoid one losing trade and you get one winning trade, right? So this is one example. I can walk through with some more examples as well. So now we will go back to the same examples which I took in the beginning of this PPT. So now this is Axis Bank once again. If you observe very carefully, friends, in the first short trade, the 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 two candles closed, below the OR below, right? But if you observe the wick, there is a big buying wick, right? It is more than 20% of the entire candle. So automatically, and also the price in the green candle, the price didn't trade below the low of the first candle, right? So because of this reason, you don't take a short trade in the first case. In the second case also, price didn't close anyway above the high of the ORB high, and also there is a big selling wick, right? So in both the cases, you avoid two trades. If you apply the filter as it is, on this particular day, if you are trading Axis Bank, you avoid two failed trades, right? So this is how the filter plays a very crucial role to increase your success in ORB strategy. Now one more example. So now this is Axis Bank, the same thing. So in the first case, if you observe very carefully, price didn't close above the ORB high, right? And also there is a big selling wick. So we don't take a trade here, right? So which means we have avoided one losing trade using the filter, right? Now, if you observe this carefully, again in the first scenario, the first circle, green circle, we don't take a trade here, right? Because of two things. Number one, there is a big selling wick. I mean, it is more than 20% of the selling wick compared to the body. That is one thing. Because of that reason itself, we don't take the long trade. However, price didn't trade above the high of that candle and the next candle, right? So because of these two reasons, we don't take the trade, right? So that's why we have avoided a failed trade in this case. And similarly, in this case, for example, first circle, the which is rounded in the green circle, we don't take the trade here, right? Because the price has not closed above the high of the ORB. That's one thing. And the second thing is there is a big selling wick, right? So definitely when you use the filter as it is, it don't suggest us to take the trade, right? And if you look at the red candle, definitely you might have taken it at, that's a different story. But if you have avoided, I don't mind even if you don't take a long trade the second candle, because avoiding losing trades is very very important, right? So but definitely if you follow my filters, definitely you would have not taken a first long trade, right? So it's all about winning, it's all about avoiding losing trades, right? So now if someone says, their strategies, I have seen many ads or many videos on Insta and YouTube, and which says they are getting 90% accuracy, 100% accuracy. But in my opinion, if somebody says their strategy gives 100% success, then is either a god or a liar, right? Because it's very difficult to get 100% or even 90% or even 80% accuracy in trading. Okay. So why? Because see, in this case, the price has closed above the ORB high, but it has a selling wick, small, it's a decent selling wick, right? It definitely, it's more than 20% of the selling wick. Now, if you apply my filter as it is, you don't take the trade, right? But you would have missed an opportunity, right? We missed a decent, pretty good trade. So that's why I say, even if you use this filter, sometimes, very very rarely, you might miss a good trade, but that is fine. Avoiding 70-80% of the losing trade, it's very very important. Why? Because see friends, whenever you take a trade, the outcome, your trade can have only five outcome. Okay, definitely it's not more than that. It can have only five outcomes. Number one is a break even trade, small profit trade, small loss trade, big profit trade, and the big loss trade. So whenever you avoid the last one, okay, that is big loss trade. So if your trade outcome is only break even, small profit, small loss, small loss, small profit, big profit, so you definitely stay in the game, right? So all you have to do is avoid the big losing trade. So whenever you avoid losing trades, automatically you stay in the game, right? Now, similar logic we can apply for short trades as well. For example, breakdown candle should close below the war below, and the buying wick in the breakdown candle should be less than 20%. Okay. So if you see this, the price has closed below the war below. And if you look at the wick, it is very tiny, right? It's very small. So this is definitely less than 20% of the entire body. So our trade should come below the low of the breakdown candle, and our stop loss should be above the high of the breakdown candle, right? So this is the logic. Now, this is the logic for short trades. And whenever you are using this strategy or any intraday trading strategy, I suggest to use two important money management rules with respect to intraday trading. So don't risk more than 1 or 2% of capital per trade, which means if you have 1 lakh rupees, so if the trade fails, you should not lose more than 2000 rupees. Whether you trade option selling, futures, or equity, doesn't matter. Okay. So if the trade fails, you should not lose more than 2% of the capital per trade. This is the one important thing. And the second important thing is, don't take, I suggest, two trades are enough on any trading day. You should not take more than three trades on any trading day, because even if you face three failures on any trading day, you end up losing maximum 6% of your capital, right? Because I have seen many traders uh, uh, who loses their capital in 1 day or 2 day, but I have not seen with traders, even a single trader who loses his entire capital over 100 trades actually. So which means people get into the emotion mindset and they end up losing more trade because of the revenge trading. So I suggest to avoid revenge trading. The best way to avoid revenge trading is, don't risk more than 2% of your capital per trade, and don't take more than 3 trades on any trading day. Okay, so this is the two important money management rules for intraday trading, irrespective of the strategy you use. Now we will go back to some of the charts, and this is third rule is also very good. If you face two failed trades on any intraday trading, you can avoid trading on that day. So after this, because if you follow the third rule, you don't lose more than 4% of your capital, right? So these three important rules are very, very important. Now we will go back to the charts and see. So there is an indicator which is called as initial balance indicator. If you apply this indicator, what it does is it highlights this small green color. It highlights the 1 hour range in small green color. Okay. So now observe very carefully. You don't take a trade here, right? Because there is a big selling wick. So even if you take a trade here, because this candle satisfied the breakout criteria, so it is a almost a break even or a small profitable trade. Definitely it has not hit the stop loss, right? Now if I come back further, I will walk through with some of the trades. Okay, so then you will get more clarity. See here, you don't take a short trade, right? Because this particular candle has a wick, and also the next candle didn't trade below the low of the candle. But anyway, this candle has a big wick, so you don't take a trade. So this is a small kind of break even trader. It's okay, no problem. And if you go little further here, okay, so you might have taken a trade here. This breakdown candle is very, very huge. If you would have taken a trade here, it would have resulted in a loss. It is fine, no problem. In this case, you would have taken a trade here, but it is a break-even trade or a small profit trade. It is fine. See here, friends. See here. No, this is where the beauty of the filter comes into the picture. See here, definitely you would have not taken a short trade here, right? Because the price didn't close. Sorry. 1 second. Let me clear this. Okay, so I got confused. See here, this is the one over below. So this wick is less than 20%. It is fine. So if you have taken a short trade in this particular candle, your stop loss should be here, right? Your stop loss should be here. See, it has not hit your stop loss and it resulted in a decent profit. Okay. Now, if I go further, here it might have resulted in a small loss. Okay, it is fine. Okay, here see, this is very important. Now if you had have followed my filter as it is, see, there is no breakout here, so the entry will come above. It satisfied the criteria, right? Price closed above the high of the ORB and the selling wick is negligible. This perfectly satisfy the filter criteria. Your entry will come here and your stop loss will be comes here, right? And it went upside. You would have made a good profit here. So now if I go further, I'm looking for a few examples which avoids the unnecessary trades actually. See here, for example, if you check this, if you're trading Infosys on this particular day, if you are using my filters, you don't take trade here, right? Because price even in this candle actually, okay, you don't take the trade because the price traded below the over below, but it didn't close in this particular candle. It didn't close below the over below, and also the selling wick high, right? In this candle, it closed below the over below, but it has a buying wick, right? So because of these two reasons, you don't take the trade and you save your capital, right? So even I think in this case it went little upside above, so you don't take a trade. So you would have avoided two easily trades on this day. Even on this particular day, you would have avoided the trade here, right? Here and here as well. because it doesn't satisfy the criteria. I'll go a little further. You can check any stock. For example, if I go to, for example, TCS, if I go to TCS, the same logic applies here. Okay. Here, see, you would have missed an opportunity, right? It displayed a big selling week, then it moved upside. Sometimes this kind of information, this kind of move happens. It is fine and okay. So don't worry about it. So in this case, see this candle as less than 20% of the week, you would have taken a short trade, decent profit. So in this candle, see here the price closed above the ORB high. The wick is very very less. Would have taken a long trade here. Stop loss is here. It has not hit your stop loss. Price went upside. So here you would have avoided the short trade, right? Because it has a sell. I mean the buying wick. Okay. So you would have avoided one break even trade. Here you would have taken a long trade because the wick is less. That's fine. You would have taken your stop loss, but that is fine. Sometimes this kind of move happens. Here you would have not taken a long trade, right? Because this contains more than 20%. It close to 50% of the buying wick in all these candles. So you would have avoided taking a long trade. So it resulted. I mean, you would have avoided one losing trade, right? Okay, so you can check many example. I suggest, see here in this candle, the price closed below the OR below. It is contains less than the 20% of the wick. So entry comes here, the stop loss is here. You would have made a decent profit, right? See, friends, whenever you use a strategy, see any particular trading strategy works in certain market condition and it doesn't work in certain market condition. So whenever it doesn't work in certain market condition, we should ensure that we avoid taking much trades in that particular market condition. See, ORB is a very powerful intraday trading system, and you should use smartly or intelligently to avoid the losing trades. See, whenever you use these two filters with respect to ORB trading, automatically you avoid taking more than close to 60-70% of the losing trades, and automatically your overall trading turns towards the profit side. So I hope this particular information is helpful. Now I'm going to explain one more important trading strategy, intraday trading strategy in particular. The second strategy is bit risky for beginners. If you're a beginner in intraday trading, I suggest to avoid this strategy and to use only the ORB strategy I explained right now. But if you have some experience in intraday trading and if you want to explore it further, then you can look for this strategy. However, I suggest to watch this video completely and try to understand the strategy in depth before applying the strategy. Okay, so this is involves open action strategy. This is one of the open action strategy which enables you to take the trade at open action, and if you are right, it gives you a very very good profit, and one should be quick enough to you know uh, close the trade or to trial the stop losses as well. Okay, so now the second important strategy is it's called as initiative balance strategy. Okay, so the logic works like this. For example, there will be previous day high and there will be previous day low. So right now I will refer this as PDH and I will refer this as PDL. Okay, this is previous day high, previous day low. Do you know why this previous day high and why this previous day low formed? So the simple reason why previous day high formed is there are no buyers above this level, right? There are no buyers above this level, or the strong selling came from this level, right? That's why the PDH formed. Similarly, PDL, there are no sellers below this level, or the strong buyers came at this level, right? So now that's why PDL, previous day low, is formed. Now, okay, assume price close somewhere here. So now the market is closed. And tomorrow, if the price exactly opens at the same level, which means there is no change in the market sentiment, right? Because the price closed here, somewhere here, and price is opening exactly at that level. So market is closing at 3:30, and tomorrow morning 9:15, there is a lot of time, right? And if the price open exactly at the same level, it indicates there is not much change in the market sentiment. However, if the price opens here, okay, if the price opens here, it indicates there is a change in the market sentiment, right? Because it's opening with a gap and it is opening at the previous day high. Now here, okay, from here, this zone belongs to the strong sellers yesterday, right? It belongs to the strong sellers. So if the sellers are really strong, okay, they should they should come and push the price towards the downside, right? And if they didn't participate, if they don't come, so what indicates and confirms is there is a high possibility of price trading in the same direction. Okay, I will repeat once again. So there will be previous day high, there will be previous day low, previous day high, previous day low. Price opens at this level. Okay. Now this zone belongs to the strong sellers yesterday. Okay. Yesterday, if there is not much happened in the market, which means this is an very beautiful level for them to initiate their selling position, right? So they should come immediately and they should push the price downside. But if they don't appear in the first candle, remember friends, we are using 50-minute time frame. If they don't appear in the first candle, what it indicates is their absence, or they have changed their mindset, right? Okay, so this strategy around or revolves around this particular logic. The same logic applies to towards the short side as well. For example, if somewhere price is closed here, if the price is opening here and it closed below the low, it means okay, this zone belongs to the strong buyers yesterday. So it means either they're absent today, or the market conviction, they have changed their conviction, and hence they are not participating, right? So there is a high possibility of price going in the same direction. Okay, so the overall logic is, let's say this is previous day high, this is previous day low. So what we do as part of initiative strategy is 50-minute time frame. We will wait until the completion of the first candle in 50-minute time frame. If the price closes above the previous day high with a small selling wick, then we will take a trade above the high of that particular candle, keeping a stop loss below the low of the candle. Okay, now we can target either 1 is to 2, or we can trial our stop loss below the low of every swing. Okay, so these are the two exit strategy one can follow. I hope this is clear. Similarly, for a short trade, we will wait until the closure of the first candle, that is 9:15 to 9:30. If the price closes below the low of the previous, below the previous day low, so this is a red candle, then we will take a short trade below the low of the particular candle, keeping a stop loss above the high of that candle, and we will aim for 1 is to 2 risk reward target, or we will trial our stop loss below the low of the every swing high. Okay, I hope this is clear. I will show some of the examples. We can get this information on most of the stocks actually. Let's say we will go to Titan, for example. If you go to Titan also, mm, see here, for example, here this is the previous day low, right? This is the previous day low, and this somewhere it is high. Don't worry about the high. Look at the first candle, okay? The first candle closed below the low of the previous day low, right? And it has very less buying week. So our entry will come here and our stop loss will be here, okay? So in this particular candle, if you think the candle is big, you can keep a stop loss here, okay? Here also it is fine. So now here, if you look for 1 is to 2, it comes somewhere here. Okay, it is a profit. Or if you're trailing a stop loss first to the entry point, then somewhere here or somewhere here, then it would have taken your stop loss. That is fine. I hope you got you got to know how to use it actually. Even in this case also, the price closed above the previous day high. You can take a trade here, but it resulted in a if you trialed your stop loss, it would have taken a stop loss, trial stop loss, a small loss, but 1:2 target, 1:2 target, it didn't came. And okay, if you look at this, for example, in this case, price is very close to the previous day high. Okay, it also comes under ORB actually. So if it have taken a trade here, it is fine. Otherwise, ORB trade anyway will come into the picture. If you look at ORB, it is a good thing, right? So there is less than 20% of the wick. Entry comes here, stop loss comes here. It is a very good trade. Okay. So now IB comes here. IB trade comes here. See, for example, so this is uh, previous day high. If it have taken a long trade here, the stop loss will be below this. Okay, 1:2 target is come here, or if it would have taken a your trial stop loss. Now, if you can check like this, you can check like this many things. For example, if you can check some other stock, for example, if you go to Reliance, you should observe one interesting thing with the strategy. So what it does is it gives very quick profit actually. Okay, so that is the beauty of the system. See, for example, in this case, this is the previous day, this is the this is the previous day high. Somewhere here, price opened above this level, closed below. So entry comes here, stop loss comes here. So 1:2, it didn't came. Okay, it's a small profitable trade on the particular day. If you go little further, for example, okay, mm, there is not much with Reliance. There is one trade here. It closed, opened and closed below the previous day low. Small profitable trade. This is fine. Suppose if we check Adani Enterprises. See, one initiative trade is here. So this is previous day low. Price opened, very close to the previous day low. It closed below here. So this is your entry point. This one is your stop loss. So I think it came 1:2 or trial stop loss, or you would be carrying till end of the day, right? So there are okay, there is one more initiative trade here. So this is previous day low. Price opened at the previous day low, closed below the previous day low. Buying wick is very less. This is your entry, this is your stop loss. So 1:2 target here, or your trial stop loss. Okay, you would have made a profit, right? So this is how this works. We can check for one more stocks. For example, if you go to Tata Motors or Tata Steel, see here, this is one initiative trade. It resulted in a small profit. So this is also an initiative trade below the previous day. It resulted in a small profit. Okay, this is no trade here, no trade here. Here, one more initiative trade. It closed below the previous day low. It resulted in a very good profit, right? See, the beauty of this particular strategy is whenever you get it right, it gives very good profit in quick time. Okay, so this is the beauty of the system. So I always remember three rule, friends. Number one, you should not lose more than 2% of your capital per trade. Number two is you should not take more than 3-4 trades on any trading day. That is very, very important. And number third rule is whenever you face a two failed trades on any intraday day, you should close your laptop and you should go outside. Whenever you follow these rules as it is, definitely you don't lose more than 5 to 6% of your capital on any trading day, right? I hope this video is really helpful, friends. If yes, please like the content and share and subscribe to my channel and share it with your friends. See you in the next video with another useful content. Till then, thank you. See you. Bye bye.